Okay, we're on the last chapter, so let's finish up this class. This is nothing different than you've done before. It's closing entries, and you've already done closing entries, so let's take a look at what they want us to know. The difference between you. This is stuff, nothing new that you haven't done before. Prepare an income statement. This income statement is going to be a little bit different than the normal income statement that you're used to looking at. Owner equity and balance sheet. Journalize and post adjusting entries, post the closing entries, make a post-closing trial balance, journalize and post the reversing entries, and define accounting terms. It's new to this chapter. Okay, so they're asking us to go ahead and look at what a multi-step income statement is, which is different than the income statement that you've done already. It's because there's little groups that it's broken down to. You always have your revenue minus expenses, but now they have it, even those broken down even further. So it looks a little bit different. We have what's called a single step income statement, which is what you've done this whole semester until now. Total revenue minus total expenses, net income. And now you have to deal with the revenue section, which is going to be a little bit more complicated because you're going to have your sales or your revenue, but now we got to take into account all those discounts and stuff that we didn't have before. So we have to figure out net sales now, this time around first for the first section of the income statement. Okay, where am I? Then we need to figure out cost of goods sold, which is an expense, right? It's the merchandise that you buy and what the real cost is. And there are three things you need to compute the cost of goods sold. That's the beginning inventory that you have, the cost of the new purchases, and the ending inventory. So here's how we figure it out. We take our purchases. This is for the net for the cost of purchases. We add what it cost for the freight. We subtract our purchase discounts that we've given and subtract our returns that people have returned. That gives us the net delivered cost of purchases. Then to figure out what we have available now for sale, we take our beginning inventory plus the net cost of purchases that we just figured out, and that tells us our total merchandise that's available for sale. And here's the entire formula for cost of goods sold. Beginning merchandise plus the net delivered cost purchases, that's the cost of goods available. Now you subtract the ending inventory, and then you have the cost of goods sold. You'll never have to remember this formula. It's pretty much given to you. You can always write it down if you were taking a test in Accounting 1. This is going to be the next accounting level class. They really cover a lot of this cost of goods sold material. It won't be new. Okay, your merchandise inventory account is an account that appears on the income statement and the balance sheet. Beginning and ending merchandise inventory balances appear on the income statement. And the ending merchandise inventory also appears on the balance sheet in the asset section. So you're going to see what that looks like. Here's a partial income statement. Notice it's just not revenue minus expenses, net income. You have to figure out the whole cost of goods sold that's going on here. And this cost of goods sold is part of the entire income statement. So here we've got what's available for sale, and there's your total cost of goods sold once you subtract your merchandise that you have on hand. Okay, let's see. Net sales is the revenue we earned from selling our antiques. The cost of goods sold is what our antiques paid for the antiques that were sold. The gross profit is what's left over to cover our operating costs and expenses and provide a profit. And the gross profit is the difference between our net sales and the cost of goods sold. Notice it's net sales and not total sales, and the cost of the goods that we had for sale. So let's look here at a partial income statement again. These are real complicated because they're like 4 columns, and you always got to look and say, okay, what goes in what column? Which is a difficult thing to decide, right? Fortunately, our computer software does that for us. It's your job to figure out what these other numbers are that belong in the system and why they're there. But here's gross profit. And that's what? Our net sales minus the cost of goods sold. And it's all in the last column. Okay, then you're always going to have this other income section under net income, because you're going to get income from interest, like from payable notes, payable, or maybe some miscellaneous income from some other work on the side that doesn't classify as selling anything. Then you also have other expenses. So those are always to be taken into account on a multi-step income statement as well. So check this out. This is what's called a classified income statement from the worksheet. So here's your worksheet, and you have to use all the expenses and all the income to compute the net income from operations. So it's quite an extensive financial statement. So their net income comes from gross profit on sales, the total gross profit on sales, minus what? Total operating expense, net income from operations. Then you have to add miscellaneous net income, or subtract, miscellaneous expense. And there's your total, which isn't a whole lot of money. Your profit of what is $50,000 on bringing in $219,000. So that's quite a bit of operating expense. So in this scenario, we're selling almost $220,000 worth of profit on sales, and with all the expenses, we're only making or keeping at the end of the year $50,958. All right, so they want you to look at what the owner equity now would look like. The capital at the beginning of the year, we're going to take that $50,000 net income, then we're going to subtract everything that we pulled out of the bank, the withdrawals. That'll be our total increase in capital, and so our owner equity is $84,000 instead of $61,000. What are current assets? We talked a little bit about what current assets are and long-term assets. The current assets go in the current asset sections. Those are those things that you can easily convert to cash within 1 year. Things that take longer or depreciate over the years, like plant and property and all that other stuff, is a long-term asset. Okay, so here is plant and equipment, our long-term assets. They're usually, the sizable part of the investment. So here's a little bit of a partial balance sheet. You'll have the plant and equipment, but this time you're going to have to write down all the accumulated depreciation next to each piece of equipment. Same with the liabilities. Liabilities almost look the same, except now you have notes payable, accounts payable, interest payable, Social Security payable, tax payable, unemployment tax payable, salary payable. So many payables, so many liabilities. But the balance sheet, remember, just has the assets, the liabilities, and the owner equity section. And the owner equity section. Nothing that you didn't know before, except that these are more complicated. Okay, there's a recap, which is really cool, of the adjusting entries. So, inventory adjustment removes the beginning inventory and adds the ending inventory to the accounting records. Remember, we did that the last chapter in chapter 12 with the income summary account and the merchandise inventory account. Expenses matches the expense to the revenue for the period. Then that would be like depreciation for one thing. Depreciation expense matches it to the asset that depreciates. Accrued expenses means that its revenue has been incurred, but not yet. It's still a liability. We still haven't performed the service to actually earn the money. We just took the money first. Prepay means we paid first, and we prepaid that asset. So it's a credit to our asset account. Okay, and let's see. Let's move on to what accounts are temporary. And we know that the balance sheet accounts are permanent, right? And the temporary accounts are anything having to do with revenue and expense. That's why we close the revenue, we close the cost of goods sold, expense accounts, and then we close the drawing account, the owner equity account. The 4 steps are the same 4 steps that they were in the other chapter on closing accounts. First, we close the revenue, and we closed that and the cost of goods sold accounts to the income summary account. Then we close the expense, cost of goods sold accounts with debit balances, because those are cost of goods sold with credit balances, and any other revenue accounts to the income summary account as well. Then we close the income summary account to the capital account. And the last thing we do is we close our drawing account to the capital account. So that's what it looks like in the general journal under closing entries. Same thing with your project. You'll do closing entries. You just won't have all these accounts. You close revenue, right? And all the things that are related to the revenue, which is a lot here. Okay, and then you close it to the income summary account. And then you're going to close the expenses to the income summary account. And then on step 3, you're going to close, did I miss a slide? Credit each account except the income summary for the spelled debit income summary for the total. Oh yeah, you're going to close all the expenses, which are normally debits. You're going to put them in the credit side and then add them up and put it on the debit side of income summary. You close the income summary account to the capital account. So you have a balance in your income summary. You'll always have a debit and a credit. And you'll take whatever the balance is when you subtract the two and put it in the capital account. Then you close the drawing. Everything that you took out, which is normally a debit, you'll credit it to make it 0, and then you'll put it in the capital account. This brings all the temporary accounts to 0. The word closing is used in the description. And now we do a post-closing trial balance. The only thing that's in the post-closing trial balance are the accounts that have balances, which would be the asset, liability, and owner capital accounts that appear on the post-closing trial balance. So there shouldn't be any revenue or expense accounts in the post-closing trial balance, just the balance sheet accounts. None of this should be on the post-closing trial balance. All these have to be closed monthly so that you know every month what your revenue is. And you know every month what their expenses are. They all have to be closed every month. That's what a post-closing trial balance looks like. That's a complicated one. You'll have a much shorter, easier one in your project because you won't have, we're just dealing with the service. We're not dealing with any merchandise or discounts or anything like that. Notice how it's listed though. Assets first, then liabilities, all the payables, then the owner equity, capital. It's always in that order. Assets, liabilities, capital. Then you have to journalize. Okay, what are reversing entries? Journal entries made to reverse the effect of certain adjusting entries that involved accrued income or accrued expenses. So they also reversing entries work for any mistakes that are in the journal that you need to go back and fix. And finally, you have done everything in here. You just don't know it. And right now in your project, you have source documents that you are posting to the general journal, and then you are putting in the general ledger, and then you are putting it in the worksheet and giving me the financial statements. So what you haven't done is we haven't done the cash receipts and sales journal and accounts receivable journal or the accounts payable area, because this is all working with, we're only working with a service industry right now, but if we were working with a merchandise industry, then we'd be putting all these into play. And you've done everything. So let's go ahead and do the exercises in 13, and then we should be done. Okay, so let's look at the first one. This is exercise 13.1. The accounts listed below appear on the worksheet of Heritage Crafts, indicate the section of the classified income statement which will be reported. Operating revenue. So let's go to 13.1. Actually, I think I'm on the, am I on the right? Okay. Oh, I see. This is how we do it. Okay. The purchase return and allowance goes on which section of the income statement? Well, purchasing stuff is part of cost of goods sold because we buy stuff, and if we return it and so forth, or it's part of our inventory expense, so it's part of B, cost of goods sold. So one is B. Telephone expense. Telephone expense would go under, would it go under operating expense? Yes, because it's part of the operating the business. It'd go under operating expense. C. 2 is C. 3, sales returns. Where would sales returns go? It goes under A. It's part of the revenue, right? Because revenue and sales are the same thing. And when somebody returns something, it affects your revenue. So 3 is A. Purchases. Purchases are part of your cost of goods sold. It's part of your inventory. So it's B. 5, interest income. It's income, it's other income, it's D. 6, merchandise inventory. Part of your cost of goods sold, that's B. 7, interest expense is E. It's an other expense. 8, sales. Sales is part of your operating revenue. Sales and revenue, same thing. A. 8 is A. 9, depreciation expense. That's part of your operating the business. It's operating expense, C. 10, rent expense. Same thing, it's part of operating the business, C. 11, sales discounts. Well, sales and revenue are part of each other, so it's A. 12, supply expense. That would go in operating expense, C. 13, freight in. Part of the freight is part of buying the inventory. That's part of the cost of goods sold, B. 14, purchase discounts. That's part of buying inventory. That's cost of goods sold, B. And the uncollectible accounts expense is part of running the business, operating expense. Let's move on to the next one, 13.2. The following accounts appear on the worksheet. Indicate the section of the balance sheet that they're reported on. Okay, accounts receivable is a current asset. The delivery van is part of the plant and equipment. The prepaid insurance is a current asset. The notes payable is a long-term liability. Long-term liability, it's past 30 days. And especially here, it's due 2025. So it's like a 5-year liability. So it's a long-term liability. Anything over a year is considered long-term. Store supplies is a current asset. Accounts payable is a current liability. Merchandise inventory is a current asset. Capital, what's the capital? It's owner equity. E. Cash would be a current asset. Unearned subscription income is C, a current liability. Liability because you owe it, it's unearned. If it was earned, it'd be an asset. It's unearned. Notes receivable due in 2020. They're considering that to be a current asset because it's less than a year. Accumulated depreciation, that's part of delivery van, so that's part of plant and equipment. Notes payable due 2020 is C, that's a current liability. Withdrawing account, number 14, is E, it's part of owner equity. And the interest payable, as you're paying interest, and interest is due monthly or every few months, so that's a current liability. C. 13.3, prepare a classified income statement. Okay, so they want us to make an income statement, which is pretty complex using all these accounts. All right, so let's take a look at this. I'm not sure what I gave you for work on that. If I gave you a blank balance sheet or what. What I'm going to do is pull it up here on the side. Bridget's income sheet statement. Move this over. Put this next to it. Okay, we've got operating revenue. Oops. Okay, so it's always revenue minus expense. So you got to list the revenue and the revenue related things first. I'm not sure. I don't think I would have erased all that for you. I probably left it all in where you just have to fill it all in. But let's see. We're just going to fill in the 248. Then we're just going to fill in the fourth. Yeah, you know what? You can go ahead. I'm not going to go through step by step and take a look at how it's all filled in. Once you fill it in and do the subtraction, wow, I probably shouldn't have given you this problem. It's pretty complicated. Do your best to like screenshot that, I guess. And here's the bottom half. And here's the top half. And I'm going to move on to a problem that we have to think through. All this is filling in the numbers. It's really not a huge learning experience, except to figure out the math, you know, subtracting and adding what goes where. Those are things I don't really like to focus on, especially since you know your software is going to do it for you. You just need to know why it's listed this way. Why are we doing revenue first? Why are we subtracting sales return allowances? What does that mean? It means net sales. You know, what does cost of goods sold mean? It means the cost of holding this inventory in hand. You know, once we add our purchases and freight and everything together, what the total cost is. And so on. There's your total for cost of goods sold, 107,2250. You go back to the slides, you have the PowerPoint slides, and you can go back through and write down the entire formula for cost of goods sold, which you would need to know. And you would have to know that on any test in Accounting 1, if you're in that class ever. Take a look down at the expense area. You separate the expenses here from operating expense. Notice this. You have an operating expense area, and they separate it from your administrative expense. Totally different categories. They always do that. Every company operates, separates the selling expenses from the administrative all the time, because some things are taxed differently. You know, like the administrative expenses, I think that they're taxed differently than a salesperson. Like up here, you might want to have commissions and stuff on your sales. So it's going to be a whole different, it's also another tax bracket, I believe. I can't remember off the top of my head, but they always do separate administrative out. I believe it's because administrative in the tax world, you can write off a third of those expenses on your taxes. Let's go ahead and look at the next one. Prepare a statement of owner equity. That shouldn't be too bad. We have a capital and a drawing account. And we're going to go ahead and use the worksheet that we have going. We're going to grab the net income and exercise 13.3. So what is our net income for the year? Down here, 49,975. We're going to need that to make the statement of owner equity. So let's see what that looks like. That's the balance sheet. Income statement. There's your statement of owner equity. We got the 42,975 income from the worksheet. We have the capital from the book, 63,760. We have the withdrawals for the year right here, 40,700. We have the increase in capital would be the difference between the two. Then we go ahead and add that to our capital that we have now. So we had 63 and now we have $66,000 worth. And now they want you to do the balance sheet. You're going to need to know, let's see, they tell you the balance of notes payable. Obtain the ending capital from the period of the owner equity. So you're going to need the ending capital, which is right here, the 66,035, to put into the balance sheet over here. So 66,035 will go down here. 66,035 into the capital there. So look at the balance sheet. Notice the current assets always come first in order of liquidity, then total current asset lines. You're going to add up that separately. Then you have the long-term assets, which take depreciation out of all of them. Then you have a total asset line. So you have your total assets. Wherever there's a double underline, it means that's over and added and done with. And the total assets are supposed to always equal the total liabilities plus owner equity. So your 11,225 here in liabilities plus your capital will equal your double underline here, liability plus owner equity, 77,260 and 77,260 for assets. I'll leave that up for a second if you want a screenshot to help you fill it in for your homework. All these figures were just simply taken from this here. So you could try it on your own first and then go ahead and fill it in. Last exercise looks like journal entries. Okay. The classified balance sheet is 13.5. That's what we just did, I believe. 13.6, recording the closing entries. Okay, so first thing you do is you close the revenue accounts, right? And then we close the expense accounts. Then we close the income summary. And then we close the drawing account. So those the order we have to do it. So here's our balances. And we know we have to first close anything that's related to revenue. So let's list those. We've got here revenue. That's your sales. Okay. Your interest income is revenue. The purchases, purchase discounts, purchase return on allowances, all part of the revenue. All part of income. And all that is normally a credit because it's all part of revenue, and credit revenue is a credit. So we have to debit it all. And that means we credit the income summary. Now we do the opposite now for the expenses. Okay, part of the expenses are these. So you got to kind of leave income summary blank to get all these added up. Sales return on allowances, sales discounts, purchases. These are all expenses. Purchase the freight costs of buying the purchases, then rent expense, utility expense, phone expense, and so on. And you're probably thinking, well, why are these sales things, when they're related to sales, not up in the sales area? That's just simply because they are contra accounts. They are the opposite accounts. Like your sales account is a credit account, right? When you sell something, it's revenue. Revenue is a credit. When somebody returns something from the sales, it's a debit account, like sales return and allowances. So because it's a debit, it becomes part of the expense area. And now we're crediting it to close it out. So that's how we're going to close down that to the income summary. Then we're going to close the income summary account balance. So that means the income summary will be this amount minus this amount, because this amount in the credit side, and we'll have this amount in the debit side, and we'll subtract the two, and that'll be this amount, and that's the amount we're closing. We'll close that to the capital account. And then of course you have your drawing. Is the drawing here on this side? Tell us what the drawing was. Yeah. He had drawing of 30,700. And that's where the 30,700 came into play over here. And move on to the next one. How many are there? 9 and 1310. Okay, so 1310 is the last one. So let's go to 13.7. Examine the following adjusting entries. Determine which one should be reversed. Show the reversing entries that should be recorded in the general journal. Include the appropriate descriptions. Adjustment A. Uncollectible accounts expense. Allowance for doubtful accounts. To record the estimated loss based on 4% of sales. All right, let's take a look at what they want us to do. Okay, I'm going to find it. 13.7, page 21. It starts with January. I need to look at December's. Huh. Let me see if I can find it. I'm going to put you on pause in a second. Okay, looking at 13.7 again. These are reversing entries. These are entries that we have not done yet. What we have done is adjusting entries. So looking at these adjustments, the first one is fine. There's nothing you need to adjust. And that's because nothing there is accrued or deferred. Accrued meaning, deferred meaning prepaid, and to the point where it's not like been adjusted. And accrued meaning that we have not, it's an expense that we have, but it needs to stay in this year. And these entries were made to put into the following year. So we have to fix those kind. First kind's perfect, don't need to do anything. Second one's perfect, don't need to do anything. Third one's perfect, don't need to do anything because your insurance did expire. So yeah, you did put it in the right expense account and everything. Fourth one's fine, you record depreciation. This is where it becomes complicated because it's accrued salary, which means a salary that you owe still, and you owe it for December. It should stay in December. And instead, what they did was by putting it in the journal this way, it shows up next year in January. So you have to reverse it and keep it in the December books as a December expense. So we go ahead and reverse that. And that's what this first problem does. It takes the salary payable. At this point let's move it over where you can see it. Okay, salary office expense, which is normally a debit, puts it back in the credit column to get rid of it. And salary payable, which is normally a credit, takes it out of payables and puts it in the debit. So now it's not recorded as a salary that you owe for January. It keeps it in December, so it keeps it in the December books. So it reversed it to keep it in December. And that's all we're doing for the next two as well. Same with the taxes, the payroll tax expense here. Here. Payroll tax expense. Payroll tax expense would normally be a debit, so now we're going to take that and put it in the credit. And the payables we're going to take out of the payable column in the credit and put them as debits. We're going to reverse it so that the expenses stay in the proper year that they belong. Because what they did by putting it in the expense and payable, it ends up in January of the following year. They did the same thing to notes, two notes, one where they pay interest on and one where notes receivable, notes payable. They reversed both a notes payable and a notes receivable to adjust the income so that the income is recorded in the proper month that it's received. And the expense will be now recorded in the proper month where it becomes an expense. And I wouldn't worry too much about this problem. Again, this is something your computer would figure out. This would be nothing that you would have to worry about. You wouldn't have to do reversing entries. I think pretty much is built into the software of Peachtree and QuickBooks. So I don't want to focus too much on it. I want to focus on what financial statements look like and what they're for. Let's move on to a post-closing trial balance. These are important. This asks you to prepare a post-closing trial balance. So by doing that, you know that only thing that goes on a post-closing trial balance is the balance sheet accounts. Assets, liability, owner equity, nothing else goes on a post-closing. So let's look at what it's supposed to look like when it's done. And shrink it. And move it over. So look what we've got. Assets, all the way down to line 16. Liability, 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 and capital. Assets, liability, capital. That's all that goes on the post-closing. So all you're going to do is transfer the numbers here over to this sheet. However, notice the capital here, 281,640. Is it going to match the capital here? 299, because you have to figure out the net income and all that. That's why they've given you all these other figures, like sales and all that. You're going to have to do the revenue part minus the expense part, figure out the net income to figure out what the real capital is. It doesn't say, here's what it really is. So yes, you'll have to go through and figure that part out. Sales, sales return allowances, purchases, you're going to do the whole computations. And then you'll be adding that to the capital that you have here. And the same with the drawing. You'll have to subtract the drawing out of there as well. I should probably do that on the side, pause it, and then come back to it. I might do that. Let me just move on to the next problem so you can take a look at this. I just want to see what the next one's about. What's 13.9? 13.9 is what you need for the real world. What is net sales? What is gross profit? Current assets? What are current liabilities? What is working capital? What is the current ratio? What is the inventory turnover? Average inventory, accounts receivable turnover. How many, that means how many times a year does your accounts receivable turnover? That 10's pretty good. That means people are pretty much paying within a month. Average accounts receivable, and so on. These are all formulas that you'll be doing. And that's just filling out and doing the math. So let's take a look at what that looks like. Calculating the ratios, they gave you everything, and you just do the ratios, which are right there. And that's what they look like. And what's 1310? Out of curiosity. That's it. Accounts receivable turnover is 8 times. We're trying to figure out is how often are you customers buying and paying on time. Inventory turnover. Okay. All right, so the computation ones you guys can just do, filling out on yourselves, filling this in. That's not a big deal. It's just simple math. I'll leave it up for a second. And scrolling on down for the second half. Okay, let's go back to the post-closing trial balance because that's what's important, these financial statements. Okay, let's figure out how they got the $299,380. So I'm going to pause, I'm going to do the math, and then come back and walk you through. Okay, I'm picking it up on exercise 13.8. 13.8 gives us these figures here. And it asks us to do a post-closing trial balance. So some of these accounts you can just carry over the amounts because post-closing, you know, are just the balance sheet accounts. However, you can pull over the assets and you can pull over the liabilities, but when it's time to pull over the capital, given all this additional information that they give you, you have to figure out what the real capital amount is. It's not $281,640. Instead, it's $299,380. And why it's that amount is because of this. Because the difference between the debit and credit of the income summary account, if you subtract the debit and the credit of the income summary account, you'll get $17,740, and that's your net income. So you're going to take that $17,740 and you're going to add it to the $281,640, and that is how you're going to grab the $299,380. So that's the difficult part of this post-closing trial balance, and that's how you would do that. Because the income summary is all you need to look at, because the income summary, you've already closed your expense accounts and already closed your revenue accounts and all that. And the difference between the two is your net income. That's what income summary is all about. Okay, let's see. Let's go on to the next one. I think the next two were just ratios that I was just going to talk about. These other ratios that you just have to compute. Again, you know, it's just simple math. So you just fill in the blanks and do the addition or subtraction. So that shouldn't be too much of a big deal. And then the last exercise is the same thing. There are two things you need to look at. It's important, the inventory turnover, because it tells you how many times your inventory is being turned over during the year. Like, are you stuck with last year's fashions from September of 2018, or is your inventory being sold? And this is telling you it's being sold 8 times over every year, 8.5 times. So these are important formulas when you get to studying what they all mean. But for now, we just need you to compute them. And that's all you need to know for chapter 13. And we're done. And it's been fun. So I'll see you via BlueJeans. Bye.